Right, guys. So in this particular session, what we shall be discussing about is the basics of group accounting, and then in this we will solve TYU 1, which you can find it even in your FR book, financial reporting book. So let's look at this particular questions regarding Dickens and Jones. So we have been given a statement of financial position, and then we need to prepare statements of financial positions of Dickens. Okay. So what we shall do is let's prepare it as per our standard pro forma. So what we will particularly do is that working note 1, so this will be our group structure. Right, so parent, and then NCI. So how much does this parent hold? Is 16,000 out of 20,000, and then this one holds 4,000 out of 20,000. So let's keep it in percentage so that it looks pretty similar. And then our second working notice, So our second working notice, calculation of net assets. Calculation of net assets of what is it? Jones. Calculation of net assets of Jones. So what we have particularly given is, so we know at acquisition and at reporting. So our equity capital, and then share premium, and then what we are given is retained earning. Right, so what does the question say? So 16,000 has been acquired, retained earnings stood at 20,000, share premium was 10,000, right? So change has been only in retained earning, which is 25,000. So let's add these values up. So 20,000, and then after that this is 10,000, and then after that retained earning was 20,000, right? So at reporting date, so the values were pretty much same for this as well, but in this case retained earning has increased to 25,000. So that's the post acquisition profit, which you can say. So let's sum this thing up. So this is our net assets at acquisition, and then net assets at the reporting date is this figure. Okay, so our net assets is already there. So what we will do is working note 3. What we can do is simply copy this working note from here, and then just edit the number at the end. Working note 3 is calculation of goodwill. Okay, so let's merge this cell, and then let's do the same for this as well. So let's merge it for this one as well. It looks pretty good, so that's why. So Control V, you can do that, and then thing as well. So it's not yet enough, so we'll merge one more cell. So Control V, just making it look pretty. So when you're calculating goodwill, what you will do is there is two methods, right? So there is either you have choice between fair value method or net assets method, but in this particular question, the question clearly mentions that we need to use fair value method. Okay, so when you're calculating your goodwill, what we will do is, first of all, cost of investment. So let's merge this cell as well, and then fair value of NCI. Fair value of non-controlling interest. So what is your cost? So when you look at the question, it says Dickens acquired 16,000 shares, $1 in Zones on 1st January 20 exit. When Zones return earnings stood at 20,000, share premium stood at 10,000. On this date, the fair value of the 20% non-controlling interest was 12,500. Okay, so the Dickens uses the fair value method to value the non-controlling interest, right? So in here, what it seems like is that he paid just $1 for 60,000 of shares, but which is not the case. So when you don't have that particular amount, so the questions might trick you, like what is the investment amount? So you can always see it in the parents individual statement in. So here it says shares in zones, right? So it says 60,000. So that's your cost of investment. So we will use that particular figure. So 60,000 and then 12,500 is your value of non-controlling interest, right? So let's add this to figure up. And then what we shall do is less net assets at acquisition. So net assets at acquisition is this particular figure, 2,000, right? So our goodwill will be, or you could also say total goodwill, because if you're using this fair value method, then you will get total goodwill method, whereas if you're doing it from the other method, then you will only get the normal figure. Okay, so I'll show you a bit of difference as well. So how it will be different, we subtract this figure with this figure, so we get 22,500 is our goodwill. Okay, so suppose if we are doing this same particular thing using I will do is copy and paste it, or control Z, control V. So when you're doing it, so your net assets would be same, right? So it would be same figure, but the only difference when you're doing is that your fair value of NCI or your value of NCI would be derived from this net assets. Okay, this is net assets proportion method. Okay, so what you would do is net assets into how much is their share of company, 20%, right? So you can always get this from our group structure as well. So that's your 10,000. So see how the goodwill has been different. So this is fair value and then net proportion. Okay, so these two methods, see how the goodwill is different. So in this particular thing, what happens is that basically you are getting this fair value of non-controlling interests figure, this figure, out of this figure, right? So it already contains the 10,000. So what you're actually doing is that you are just deducting that 10,000. So see, if you were to break this particular figure, so this would be 40,000 plus 10,000, right? So see, this figure already contains the 10,000. So what you're actually doing is that you are just subtracting the 10,000 this 10,000 you are adding it up in the above, and then in the below you're just eradicating it, so there is no part of the NCI. Okay, so you will only have the goodwill of parent. So that's how it is basically done. Okay, so that's the case. And then after that, so let's not complicate it, but this is how you actually do the net proportion method. Okay, so here this will be working note 4 would be so your working note 4 would be calculation of non-controlling interest NCI, because we will need the figure of NCI in our balance sheet as well, right? So calculation, calculation. So our fair value of non-controlling interest is already, we have it over here, 12,500. We just bring that particular figure down, and then after that, share of post-acquisition profit. So this would be this minus this. This minus this into its shareholdings. Total NCI would be then this figure plus this figure. Okay, so that's your total NCI. Okay, and then after that, so our working note 5 would be group reserves. I'm just copying everything down because otherwise I have to merge sales individually, so it just saves time, that's why. So in this case, what you would do is 100% of parent, right? So you don't have to divide the 100% of group shares, right? So you can actually keep it. So 100% of parents. So parents' retained earning is 70,000, right? So 70,000. And then after that, share of post-acquisition profit. Or what I could do is basically copy this particular, which is 80%. So 80%, we know that because our share in that particular company is 80%, so we are only getting out of this figure and this figure, so that has been the net change within the company. So the company has, see where the change is coming from, it's coming from retained earning, right? So after acquisition, what has been the profit? So you will also have a particular interest in that profit, right? So what we will do is that we will subtract this figure with the earlier figure and then multiplied by the parents share, which is 80%, right? So what you will do is 80%, and then so see, that's how you get your group reserves. Okay, so your reserves is already there since we don't have any impairments, PURP or anything else. So we will definitely look at that as well. So this is just a simple question just for the beginners. So after this, we will look at that as well, and then it'll be easier for you. This is our group reserves. So let's make our consolidated statements of financial position. Okay, so consolidated statement of financial position. Let's merge this thing up, bold, and then just to make it look nice. So non-current assets. So what we have under non-current assets, first thing, always remember when you're acquiring something, you might have a goodwill. So always keep that figure, otherwise you might tend to forget it. So our goodwill is this figure, and then we have PPE. So PPE would be 85,000 plus 18,000 because we are two company merged into one. So 5,000 plus 18,000. And then after that, what we have investment in shares, we don't account for that because it's already been touched. So whatever has been already touched, you don't actually account for it. Okay. So we don't touch that. And then current assets 160 plus 84. So current assets is CA 160 plus 84. That what is? So it's 160 plus 84,000. So what's our total assets then? Total assets bold. What's that? Current assets plus. So it's basically sum of everything. What we can do is sum of all these figures. Okay, so that's our current assets, right? So equity section